How did the Herstatt Bank collapse lead to Basel I? Imagine a small bank's failure causing ripples across the entire world's financial system. That's exactly what happened with the collapse of Herstatt Bank in the 1970s. This event changed how banks are regulated forever. Herstatt Bank was a medium-sized private bank in Cologne, Germany. It was active in foreign exchange trading, which involves buying and selling different currencies. In 1973 and 1974, the bank made risky bets on the U.S. dollar, which was very volatile at that time. These bets went badly, and by June 1974, Herstatt had lost about 470 million Deutsche Marks. That was way more than its capital could cover. The bank hid these losses by falsifying financial statements. When regulators found out, they shut Herstatt down and liquidated it. What made this event so important was not just the size of the loss but how it exposed a major flaw in the global financial system. When Herstatt was closed, it was still the middle of the day in New York. Banks that had paid Deutsche Marks to Herstatt in Germany did not get their U.S. dollars back because Herstatt's accounts were frozen. This created what is called Herstatt risk, a type of settlement risk. It showed how the failure of one bank could cause problems for banks all over the world because of how international transactions are connected. The Herstatt crisis shocked the banking community worldwide. It revealed that existing rules were not enough to prevent such risks. It became clear that stronger oversight and better risk management were needed across borders. This led to the creation of the Basel Committee on Banking Supervision in 1974. This group brought together regulators from the G10 countries to develop common standards for bank safety and soundness. Their first big step was Basel I, introduced in 1988. Basel I focused on making sure banks held enough capital to cover their risks, especially credit risks. It required banks to keep a minimum amount of capital based on their risk-weighted assets. While Basel I did not specifically address settlement risk, it was a direct response to the lessons learned from the Herstatt collapse. It showed that banks needed to be better capitalized and that international cooperation was essential to keep the financial system stable. The Herstatt event is a clear example of how one bank's failure can lead to major reforms. It pushed regulators to create rules that help prevent similar crises in the future. The story of Herstatt's collapse and Basel I's development highlight how financial systems evolve through lessons learned from past mistakes, making the global banking world safer for everyone.